Verizon Communications stock is a high yield opportunity. If we look at the dividend dashboard and look at Verizon, we can see Verizon is currently yielding around 7% with a fairly healthy free cash flow payout ratio and a history of growing those dividend payments over time. But we do have to point out that if we look at the company in the last month, it's now sold off by about 10%. So some of the fact that the forward-looking yield is now close to 7.2% is due to that sell-off. Now, with Verizon set to report earnings in just a few days on October 29th pre-market, and with the high starting dividend yield and the recent sell-off, now is a great time to assess Verizon and see if this is an opportunity. So let's go ahead and dive in. Now, if we look at this company in the last year, down by about 7.38%, and year to date, currently down by 3%. So the reason they're in the red over the last year and year to date, again, is really due to the last month, being down 10%. So what's been going on with Verizon? Well, there's a couple of different things that we can point to. They recently appointed independent board member and former PayPal CEO Dan Schulman as its new chief executive. And Wall Street did not seem to be a fan of this news, and the stock continued to sell off. And then on top of this, AT&T, basically their closest competitor, reported poor earnings just a few days ago when they released their earnings. We can see the stock was down by about 4.2% over the last 5 days, and that simply comes from a miss on revenue. So the market didn't seem to like the CEO news. They didn't like the fact that AT&T didn't perform as well in the recent quarter. But does this create an opportunity to buy a high-yielding stock? Well, let's go ahead and dive into things just a little bit more. Now, we've already looked at the dividend metrics briefly, and what we can see is, yes, it's a high yielder, history of dividend growth, but those dividends have been growing very slowly. The 5-year dividend CAGR is right at about 2%. So yes, the dividend is growing, but one of the things that I always want to mention when we see low dividend growth rates, anytime a company is increasing their dividend payments at a rate that's slower than the rate of inflation, which for reference, over the last few years, it's been about 3.4, 2.9, 2025 is shaping up to be around 3%. Anytime they're increasing their dividend slower than the rate of inflation, they're technically paying out less in dividends every single year, and unfortunately that does seem to be the case for Verizon. Now again, the yield is very high, and it's supported with a healthy free cash flow payout ratio, so the dividend doesn't seem to be in any danger at this point, especially since free cash flow is continuing to grow at a rate that supports their previous levels of dividend growth. But if we look at the recent earnings reports, we can have some insights revealed to us. Now, revenue growth was up by about 5.2% year over year, which is actually pretty fast for Verizon. But let's dive into this a little bit more. Let's go ahead and jump over to our profitability and income statement sheet. Now, again, like always, if you'd like to download any of these spreadsheets and get access to the Ticker Data add-on in Google Sheets that allows you to automatically import stock financials directly into your spreadsheet, then you can head over to tickerdata.com at the link in the description. Now, there's a couple of things that we need to point out as it relates to Verizon. Look at revenues over the last decade. It's been relatively stagnant. We can see a 10-year revenue CAGR of about 0.6% and the 5-year about 0.4%. So it's essentially gone nowhere. Now, the good news is if we look at the 5-year average gross profit ratio, it's about 45.91% compared to last year at 46.6%. So they are able to increase bottom line simply by the margins getting a little bit better. If we look at their cash flow summary, this can actually tell us a whole lot about the business. Now, if you've watched my videos before, you know that the types of companies that I love are high quality dividend growth stocks that generate high levels of return on invested capital, and to be even more particular, stocks that are considered capital light businesses. Think of companies like Visa, companies like S&P Global. Unfortunately, Verizon is not one of those companies, and we can see that here. Their cash flow from operations in the first half of 2024 was about $16.6 billion. But then their capital expenditures. This came in at $8.1 billion. Now remember, capital expenditures lowers free cash flow. So we can see cash flow from operations minus capital expenditures gives us free cash flow. And once a company gets their free cash flow, they have their 5 options. They can reinvest back into the business, pay down debt, attempt mergers and acquisitions, or pay out dividends and buy back shares. So really the key to shareholders actually being rewarded for buying a stock, whether it's through paying out dividends or reinvesting back into the business, is dependent on a company growing their free cash flow. So if capital expenditures is a high number, it's going to lower free cash flow. Sometimes that makes sense, but a lot of the times it's not ideal. So this is a capital intensive business. Now, as we've already seen, dividends are well covered by free cash flow, which is a great sign if you're just looking for that 7% yield. But now we come to 2025 guidance, and this can tell us a lot about whether or not Verizon is starting to become interesting at its current prices after selling off around 10% in the last month. Because we can see that forward PE ratio is now sitting at just 8.19. It's trading at a very low valuation multiple. And we have to remember valuation multiples a lot of the times are determined by how fast a company is going to grow revenue and earnings in the future. So let's see what type of guidance we have. What we can see is when it comes to total wireless service revenue growth, they're projecting about 2 to 2.8%, and that's remained unchanged so far this year. But what we can see is if we go all the way down to EPS growth. At first, they were projecting it to be between flat and 3%, but they bumped it up a little bit, at least the low end. They're projecting 1% to 3%. So they did increase guidance, but they are projected to grow earnings at a relatively slow rate, between 1 and 3%. And if we look at free cash flow, they've actually increased guidance a little bit in the recent quarter as well, up to about 19.5 to 20.5 billion. So make no mistake, this is certainly not a fast-growing business. In fact, again, it looks like revenue is going to grow at about 2 to 2.8%, which when we look at free cash flow growth, that's pretty much in line with what we've seen over the last 5-ish years. But nonetheless, it is good news that they slightly revised guidance, especially for free cash flow. If we jump over to our sensitivity analysis, I've already plugged in Verizon, but really what I want to pay attention to is what EPS growth rate projections look like moving forward for this stock. And what we can see is if we zoom in just a little bit, the projected EPS CAGR through the year 2029 is sitting at about 3.18%. So again, somewhat in line with what we've seen historically speaking for this company. So by 2029, the average analyst estimate is projecting $5.31 in earnings per share. Now, if we compare that to where the company is right now, again, we'll plug in Verizon. We can see right now earnings per share sitting at about $4.15. So again, not fast growth, but it does look like they're projected to trend in the right direction. So with that being said, what do they look like from a valuation standpoint? We understand what type of expectations we should have with Verizon. It's a high-yielding stock with sufficient dividend coverage, but low revenue and earnings growth projected moving forward. Well, we can see they're trading at an astounding free cash flow yield of 11.97%. So what that means is for every $100 you invested into the company, they would be generating around $12 in free cash flow. So let's go ahead and jump into our valuation model and look at Verizon. And let's just quickly run it through all 5 valuation models, and we'll start with Graham's valuation. Again, you can see the formula laid out here. It's basically valuing the stock based on projected earnings growth. So what I've done with the ticker data function, as you can see, I pulled in the projected EPS for Verizon in 2025, which came in at $4.69, and I applied that to the model. Now we need to apply our growth rate projection, which again, like we saw on the sensitivity model, is around 3.2% moving forward, so that's what I applied. But then once we run through all this top part of the valuation, we need to divide by Y, which is the current yield on AAA corporate bonds, and this is what's driving down a lot of valuations right now. But nonetheless, when we run this through the model, we come to a fair value of about $40.40, which gives it a little bit upside from the current share price of $38.77, but not a lot. If we go to our discounted cash flow analysis, again, we're going to assume 3.5% free cash flow growth. Now, perhaps that's a little bit on the optimistic side. Time will certainly tell, but if they're growing revenues around 2.5 to 3%, and then the margins can expand just a little bit, which again, that might be optimistic just a little bit, but after finding the future free cash flows, finding the present value of those future free cash flows and adding them together, adding the company's cash and cash equivalents, subtracting out total debt to get equity value, and dividing by shares outstanding, we come to a DCF price per share of $38.80, which is essentially right at the current share price for this stock. Now, if we look at the historical multiples valuation, this is where things are a little bit more interesting. We can see the PE ratio charted out for Verizon over the last decade. Now, the average PE ratio in the last decade is about 11.7, and for the trailing 12 months, they're sitting at just 9, and like I already pointed out, the forward-looking PE ratio is just 8.19 right now. So the current PE ratio versus the average is about 23% lower compared to how they've historically been valued. Now, the caveat to that I always have to point out is if the company's projected to grow earnings and revenues at a slower rate than they previously did, then oftentimes they do warrant trading at a lower valuation multiple. So that's something to think about as you're looking at this stock. Next, let's look at the multiples valuation. Now, this is another one that's a little bit unique, at least in the case of Verizon, because we have a couple of companies that are pretty similar in nature, especially AT&T. We can see the trailing 12 months PE multiple for them is about 8.19, so Verizon's trading at a little bit of a premium compared to AT&T. But then look at T-Mobile. They're trading at a PE multiple of 20.86, significantly higher than Verizon and AT&T. Why would that be the case? Well, it's actually pretty evident if we look at how they're projected to grow earnings moving forward. The data will load in again thanks to ticker data, and look at the projected EPS CAGR through 2029, over 16%. So yes, while the business model is quite similar, you really can't even use this valuation model, or at least not use T-Mobile to be compared to Verizon, because the projected performance moving forward is so vastly different. So whenever we have a multiples valuation with just one stock, again, it's not ideal, but we can see if Verizon was being valued the same way as AT&T, the valuation could technically go even a little bit lower, and they'd be valued at about $35.30. Now, finally, let's use the dividend discount model. And to be honest, this is probably one of the better ways to value Verizon. Now, the dividend discount model values stocks based on how much they're paying out in dividends and how that dividend will grow in the future. So if we can assume a dividend growth rate for Verizon moving forward of 2.25%, what we can see is the fair value would be about $44.54, giving them around 15% upside from the current share price. So the question we have to ask is, can they achieve 2.25% dividend growth? Well, historically speaking, as long as free cash flow is above that number, then dividend growth at 2.25% is sustainable. Keep in mind that is just a little bit faster than what we've seen over the last 5 years. But with a free cash flow payout ratio below 60%, they do have some flexibility to grow the dividend at a faster rate than free cash flow if they choose to do so. And from what we see with EPS growing between about 1 to 3% moving forward and at about 3.2% projected over the next few years, I do think that could be sustainable. So if we jump over to our output tab, we do see the 4 valuation models that we use, not including the historical multiple valuation since it doesn't technically give us a per share price. But again, I don't think the multiples valuation is fair in this scenario, but it is important to see how they're valued compared to AT&T. But if we look at the other 3 valuations, we come to an intrinsic value of about $41.25, which is about 6% off from the current share price. So with a 10% margin of safety, you can see the fair price is at about $37.12. So it's not technically right within that buy range. Now, with that being said, the company is going to be reporting earnings in just a few days, and typically we do see more volatility from stocks during that time period. So maybe we'll see a slight jump up or another slight drawdown like we saw with AT&T, which could potentially put them in that buy range. Now, with that said, even if it's in the buy range, you have to assess if this is the type of company that you want to own in your personal portfolio. If you're someone that's looking for high yield and stable, predictable dividends that can grow at a slow rate, then Verizon might make sense for your portfolio. But if you're someone who's looking for long-term holdings, you're probably better off buying stocks that are growing free cash flow and growing dividends at a much higher rate. Remember, even if your long-term goal is to live off dividends like mine is, if you have a long-term time horizon, it's easier to do that by buying stocks that grow dividends at a high rate. So right now, Verizon is a high yielder trading at what looks like a reasonable valuation, maybe a slight undervaluation. If you're looking for high yielders, this might be one to consider. But go ahead and let me know what you think of Verizon in the comments down below. And like always, if you'd like to download any of my spreadsheets and get access to the Ticker Data add-on in Google Sheets that allows you to automatically import stock financials directly into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.